Finally, implement a simple system to monitor your cash flow weekly. Set a 15-minute recurring appointment every Sunday to review your accounts. Compare your actual spending against your budgeted amounts in each category. Did you overspend on dining out? Do you have leftover money in groceries? Adjust as needed. You can move money between categories, but the total must balance. This regular check-in prevents small oversights from becoming major monthly deficits. It also reinforces mindful spending habits and allows you to celebrate small wins, keeping you motivated. Consistent, brief reviews turn budgeting from a restrictive chore into an empowering financial tool. Next, create a zero-based budget before the next month begins. Give every dollar of your income a specific job so your income minus expenses equals zero. Start with essential fixed costs like housing and loan payments. Then, allocate for variable necessities like groceries and gas, followed by financial goals. Finally, assign money for discretionary spending. The key is to prioritize needs over wants and savings over spontaneous spending. Use the envelope system digitally by allocating funds to different categories in your bank app. Commit to not spending more than what's allocated in each category. This proactive plan puts you in control of your cash flow. First, start by tracking every dollar that comes in and goes out for one full month. This is your financial snapshot. Use a simple spreadsheet, notebook, or a secure budgeting app. Categorize every expense: groceries, utilities, subscriptions, dining out, and list all income sources. The goal isn't to judge but to see the honest, complete picture of your finances. You'll likely discover patterns and money leaks, like unused subscriptions. This foundational step removes guesswork and provides the raw data needed to build a realistic, effective budget. Finally, as you work to eliminate existing debt, it's vital to avoid accumulating new debt. Change the habits that led to the debt in the first place. If credit card spending is the issue, consider using cash or a debit card instead. Build a small emergency fund of $500 to $1,000 to cover unexpected expenses so you don't have to rely on credit. This breaks the cycle of using debt as a safety net. Remember, debt reduction is a marathon, not a sprint. Celebrate small milestones to stay motivated. The goal is to build the financial habits that will keep you debt-free for the long term. After choosing your payoff strategy, scrutinize your budget for extra cash to throw at your debt. Analyze your monthly spending to identify non-essential categories where you can temporarily cut back. Redirect every dollar saved directly to your target debt. Simultaneously, explore ways to increase your income through a side hustle or selling unused items. This cut and boost approach accelerates your payoff timeline. Additionally, consider contacting your creditors to negotiate for a lower interest rate, especially if you have a history of on-time payments. A lower rate means more of your payment goes toward the principal balance. First, take a full inventory of your debt. Gather statements for every single debt: credit cards, student loans, car loans, and medical bills. Create a simple list detailing each creditor, balance, minimum payment, and interest rate. Seeing the complete picture can be overwhelming, but it's empowering. You cannot manage what you don't measure. This list becomes your strategic debt payoff map. Once you have it, choose a targeted payoff method. Two popular strategies are the debt avalanche and the debt snowball. Choose the method that best fits your psychology and financial situation. To effectively fund both your emergency reserve and short-term goals, you must pay yourself first. Prioritize savings as soon as you receive your income, not from what's left over at month's end. The most effective tool for this is automation. Set up direct deposits from your paycheck to go directly into your designated savings accounts. Consistency is far more important than the amount. Saving $25 every week builds discipline and compounds into significant sums over time, creating powerful financial momentum. Regularly review your budget to find areas to temporarily cut back and redirect funds. Alongside your emergency fund, actively save for short-term goals. These are planned expenses within the next 1 to 3 years, like a vacation or a new car. Break these goals down into manageable, monthly savings targets. For example, save $100 per month for a $1,200 vacation in a year. Create a separate savings bucket or account for each specific goal. This method, often called sinking funds, prevents you from dipping into your emergency fund for predictable expenses. It helps you avoid using credit cards, keeping you on a cash-based spending path. An emergency fund is your financial safety net for unexpected expenses. For most people, the initial goal should be to save $1,000 as a starter fund for minor repairs or copays. The ultimate target is 3 to 6 months worth of essential living expenses. This protects you against major events like job loss. Open a separate, easily accessible high-yield savings account. Automate a small transfer from each paycheck, treating this contribution as a non-negotiable bill. The peace of mind this fund provides is the cornerstone of any solid financial plan. Modern banking services are crucial for smart money management. Online and mobile banking allow remote check deposits, instant transfers, and electronic bill pay, saving time and postage. Take advantage of tools like budgeting apps offered by many banks. For important payments, use your bank's bill pay service to ensure they are tracked and on time. Always enable two-factor authentication on your banking apps for security. Be wary of phishing scams. Your bank will never call or email asking for your password or full social security number. A savings account is for storing money you don't need immediately, helping you build a financial cushion. Unlike checking accounts, savings accounts earn interest, allowing your money to grow modestly. Federal regulation delimits certain withdrawals to 6 per month, so it's not for frequent transactions. To build savings effectively, automate the process with a transfer each payday. This pay-yourself-first approach makes saving effortless and prioritizes your financial security before you have a chance to spend the money elsewhere. A checking account is your financial hub for daily transactions. It's where your paycheck is deposited and from which you pay bills and make debit card purchases. The key to managing a checking account is avoiding overdrafts and their costly fees. Set up low balance alerts and consider linking a savings account for overdraft protection. Always monitor your balance and pending transactions regularly. Some holds, like at gas stations, can be larger than the final charge, temporarily affecting your available balance. Responsible credit use means leveraging credit to build a strong financial profile without overextending yourself. Pay every bill on time. Set up autopay for at least the minimum due. Keep your credit utilization ratio below 30% on each card, and overall, lower is better. Only apply for new credit when necessary, as hard inquiries can cause a small, temporary dip in your score. In the US, good credit secures lower interest rates and can affect renting, insurance, and even employment. Start by using a single card for small purchases you pay off in full each month. Your credit report is the detailed ledger behind your score, compiled by Equifax, Experian, and TransUnion. It lists your accounts, payment history, credit limits, and loan balances. Review your reports regularly for errors or signs of identity theft. You are entitled to one free copy from each bureau every year at annualcreditreport.com. Stagger your requests throughout the year to monitor your credit continuously. If you find an error, dispute it directly with the bureau. They are legally required to investigate. Your credit score is a 3-digit number lenders use to gauge your risk. The higher your score, the more trustworthy you appear, impacting the interest rates you're offered. This number is calculated from your credit report. Key factors include payment history, most important, amounts owed, length of credit history, new credit, and your credit mix. You can check your score for free through many bank apps or services like Credit Karma. For the exact score a lender might see, you may need to purchase it from myfico.com. For long-term goals, especially retirement, use tax-advantaged accounts. In the US, common options are employer-sponsored 401ks and individual IRAs. Contributions to a traditional 401k or IRA are made with pre-tax dollars, reducing your taxable income now. Investments grow tax-deferred, and you pay tax upon withdrawal in retirement. Roth accounts are funded with after-tax money, so contributions don't lower your current tax bill. However, investments grow tax-free, and qualified withdrawals in retirement are also tax-free. Maximizing contributions to these accounts should be a top priority, as the tax benefits compound dramatically over decades, securing your financial future. To avoid the complexity of picking individual stocks, many investors turn to mutual funds and exchange-traded funds, ETFs. These are pooled vehicles holding a basket of securities. The primary advantage is instant diversification, which significantly reduces your risk. Buying one share of a total stock market fund gives you ownership in hundreds of companies. They are the most practical tools for building a solid investment foundation, insulating you from the failure of any single company. Investing begins with understanding stocks and bonds. Stocks represent ownership in a company, offering high growth potential but with higher risk and volatility. Bonds are loans you make to a corporation or government, providing steady income and generally lower risk. For most beginners, a balanced mix aligns with your risk tolerance and time horizon. Social Security provides a foundation of retirement income based on your lifetime earnings. Your benefit is calculated from your highest 35 years of earnings, adjusted for inflation. You can start benefits as early as 62, but your payment will be permanently reduced. To receive your full amount, wait until your full retirement age, between 66 and 67. Social Security is not designed to replace your entire pre-retirement income. It's meant to supplement your personal savings from 401ks and IRAs. Individual retirement arrangements, IRAs, offer tax-advantaged savings, useful if you lack a 401k or want to save beyond its limits. The two main types are traditional and Roth. With a traditional IRA, contributions may be tax-deductible, and growth is tax-deferred. Roth IRA contributions are after tax, but qualified withdrawals are completely tax-free. IRAs offer a wider range of investment choices than a typical 401k but have lower annual contribution limits. Your choice depends on your current versus expected future tax rate. A 401k is a powerful retirement tool offering tax advantages and often an employer match. Contributions reduce your current taxable income, and investments grow tax-deferred. Always contribute enough to get your employer's full matching contribution. This is free money. Be aware of annual IRS contribution limits and avoid early withdrawals before age 59.5. Putting it all together integrates daily habits with long-term pillars. Your budget should allocate funds for monthly bills, retirement contributions, and annual tax payments. Use automation to fund investment and savings accounts right after payday, treating these as non-negotiable expenses. Schedule an annual financial review to reassess your budget and portfolio. This holistic approach ensures your daily financial discipline directly fuels your long-term security and legacy, creating a cohesive and effective financial plan. Estate planning is crucial for anyone who wants to dictate what happens to their assets and dependents. At a minimum, create a will to specify asset distribution and name guardians for children. Establish durable powers of attorney for finances and healthcare, ensuring someone you trust can make decisions if you become incapacitated. A revocable living trust can help avoid probate. Regularly review and update the beneficiaries on your retirement accounts and life insurance policies, as these designations typically override instructions in a will. Understanding taxes is non-negotiable for long-term financial health. Proactive planning structures your finances to legally minimize your lifetime tax burden. This involves strategic use of tax-advantaged accounts like 401ks and IRAs. It also includes being mindful of capital gains taxes and understanding how retirement income will be taxed. Adjust your W-4 withholdings at work if you consistently receive large refunds or owe money. Your goal should be to break even, allowing you to invest that money throughout the year. Homeowners or renters insurance protects your dwelling and belongings. For homeowners, insured dwelling coverage is enough to rebuild your home at current construction costs. Liability protection is crucial, covering you if someone is injured on your property. Renter's insurance is affordable and covers your personal property and liability. Your landlord's policy does not. Life insurance provides for dependents if you pass away. Term life insurance is typically the most straightforward and affordable option for covering needs like income replacement. For auto insurance, understanding your coverage levels is essential. Liability coverage pays for damage you cause to others. State minimums are often too low, so increase these limits. Collision covers damage to your car from an accident, while comprehensive covers non-collision events like theft. Uninsured motorist coverage protects you if hit by someone with little insurance. To save, ask about discounts for safe driving or bundling policies. Regularly shopping around every few years can also lead to significant savings on your premiums. Health insurance is a critical component of your financial safety net. Most obtain coverage through their employer or purchase plans on the health insurance marketplace. Key terms include the premium, monthly payment, deductible, out-of-pocket before insurance pays, co-pays, fixed fees, and co-insurance, your share of costs after the deductible. Always check if your preferred doctors are in network to avoid higher charges. Adequate health coverage protects you from catastrophic medical debt, a leading cause of bankruptcy. Putting it all together connects daily habits to a decades-long vision. Start by defining clear long-term goals, like retiring at 65 with a specific savings target. Work backward to establish the monthly savings rate needed to get there. Automate these savings transfers immediately after each paycheck. This is the single most powerful habit. Create a one-page financial dashboard listing your net worth, debt balances, and key account numbers. Review this dashboard quarterly to maintain a holistic view of your finances. Estate planning ensures your lifelong savings benefit the people you care about. It's for anyone with assets, including savings accounts, a home, or retirement funds. The foundational document is a will. Equally important are beneficiary designations on life insurance and 401ks, which override a will, so keep them updated. Establish a durable power of attorney for finances in a healthcare directive. Consolidate this review annually, verifying all beneficiaries and ensuring documents are accessible to trusted family members. Understanding taxes is non-negotiable. In the U.S., you are taxed on what you earn, invest, and leave behind. For daily spending and saving, this means being strategic.